After a strong 6-month rally, the S&P 500 just saw its 4th straight week of declines, which is the longest losing streak that we've seen in over a year. In today's video, we'll be going over the returns from last week, as well as some of the major news stories that have led to the largest pullback that we've seen since the markets bottomed out in March. As I mentioned, the S&P 500 just saw its 4th straight week of declines, as it was down about 0.6%. Now, the S&P 500 is up 2% still for the year, but at one point last week, it was actually negative on the year. But a strong Thursday and Friday led the S&P 500 back to positive territory. And as we're shooting this video, it's Monday morning, the S&P 500 actually opened up about 1.5%, so we'll see if this rally from Friday continues. Now, the NASDAQ was also up last week, over 1%, and up still 21% for the year. Now, the Dow Jones and the Russell 2000 were the two that were hit hardest last week, with the Dow Jones down 1.75, while the Russell 2000 was down over 4% last week. And now the Russell 2000 is down over 10% for the year, while the Dow Jones is down about 5% year to date. And now there were a few news stories that led to those major losses out of the Dow and the Russell 2000. The first and probably most important news story from last week was that a coronavirus vaccine isn't expected to be widely available to the public until approximately April of 2021. Now, that coupled with the fact that there were an increase in cases out of Europe and also New York City led the markets lower last week. Also, jobs data came out last week and the U.S. economy added less jobs than expected. And lastly, investors are worried that a second round of stimulus might get pushed on the back burner, as now there's a political fight about a Supreme Court justice and if that seat will be filled before or after the election. Also last week, foreign and emerging markets were down both over 3%. And that's mostly because now US and China trade tensions are back in the news, which I'm going to talk about more here in a minute. Now, after last week, foreign market stocks are down about 9% for the year, whereas emerging markets are down over 4%. As I just mentioned, the US and China trade tensions are back in the headlines. The US has placed export controls on China's biggest chip maker, and the US Commerce Department is actually making companies request permission before doing business with this company. The US is worried that equipment sold to this company could be diverted and used for Chinese military use. Also, the US and China are still in a battle over Chinese social media companies and if they can be used in the US. President Trump is still worried about the spying and data gathering out of these apps. If you remember pre-coronavirus, there were always headlines about the US and China trade tensions, which led to a lot of volatility in the market. So with the election coming up in November and now more headlines about these tensions, we could continue to see volatility throughout the end of the year. So I just talked about the returns and the news stories from last week, but let's look at some of the raw data. Last week, US stocks saw the 3rd biggest outflow on record, as about $25.8 billion came out of US stock funds. Out of that $25.8 billion, about $11.6 billion came out of US large cap stocks, and another billion came out of technology. Now, investors pulled a lot of that money out of equity and cash and moved those funds into debt and precious metals, as we saw bond funds receive about $1.3 billion from those outflows, and precious metals saw about $1.4 billion. So with these massive outflows out of the US equities and the inflows into more conservative options, such as the bond funds and the precious metals, it looks like investors are starting to get a little bit more conservative as they get closer to the end of the year, especially with the upcoming election. Thanks for watching today, and if you enjoyed this information, please subscribe to our YouTube channel and follow us on Facebook.